Energy Markets live video podcast on Thursday, the 25th of May, with Brent crude at around $78, better than it has been for a couple of weeks. I think mainly because of the comments by Prince Abdulaziz bin Salman, the Saudi energy minister, in Doha earlier in the week, which we'll talk about. The countdown has begun to what's being seen as a crucial meeting of OPEC Plus, 10 days to go before they meet. It seems virtually rather than physically in Vienna. And the OPECologists are slowly driving themselves into a frenzy of speculation, it seems. Will they stick or twist on output? Will the speculators ouch? Will the Russians deliver on their promised cuts? Will the US economy go bust just about the time of the Vienna meeting? That's a possibility. Overnight, Fitch put the USA on negative watch because of the looming debt budget crunch. Let's go first to Ram Narayanan to get a view on all this, the Director and Vice President, Strategic Market and Business Development at Vedanta in Mumbai in India. Ram, welcome. I will ask you specifically about India later in the show, but in broad terms, tell me how you see the dynamics of the OPEC Plus meeting. What are the factors on their minds as the clock ticks down to that meeting?
Hey, thanks, Frank, and good to be back on the show again. Yeah, as you set it up pretty well. Not many things going on, the comments and US debt ceiling and all. I think 2-3 points are mainly playing on the OPEC players. A, the outlook for the global economy, especially, which doesn't seem to be too good. We've seen a big commodity sell-off, which is an indication of the global economy. That's point number one. And point number two is the OPEC thought there'll be a big demand pull from China. Now, from what's the indicators that we see from the Chinese economy, as well as from all the indicators from across China, it doesn't seem to be too positive either. And within the short term, we had the US debt ceiling issue coming up. So therefore, net is, I think the outlook on the global economy doesn't seem too positive. That's what has been playing on the minds of OPEC, as far as I can see. And the second point, which I also see, is the geopolitics playing on. Saudi, the big player, is aligned with Russia, and there are a lot of pulls and pushes that is happening from on that front also. And thirdly, there is also a sort of Russia will be playing a game that, they want to push up the oil prices so that the discounts that they offer, they also push up their netbacks from oil. And fourthly, Russia will also playing on the point that US politically, the gasoline prices shouldn't go up beyond a particular point, especially with the election season just about to start. So net is, I think I see a bit of, a gloomy global economy playing on the minds of all the OPEC people. That is point number one. And point number two is geopolitics, which in the background of the Russian-Ukraine war, where Russia is trying to pull its strings with Saudi and in its fight against USA. And thirdly, of course, the China factor. Entire commodities outlook for this year was based on China, which unfortunately is not happening. So these are the reasons which I feel is playing in OPEC, making these kind of signals, these kind of comments which we saw yesterday.
Okay, we'll dig deeper into some of those. Paul Hicken, Editor-in-Chief, Petroleum Economist, London. Paul, I'd welcome your thoughts on all that, but I also want to try to get to the bottom of the Russian factor in all this. Russia promised to cut 500,000 back in March, but most experts don't think they've actually delivered that. Kepler said that forecasts of Russian output range from, quote, the bewilderingly delusional to deliberately misleading. Bloomberg, in a piece yesterday, said that there are actually 1.2 million barrels per day more in shipments from Russia now compared to February. What's your view? And what does it mean for the rest of OPEC Plus if the Russians haven't kept their promise? What does it mean for Russian and OPEC Plus credibility?
Yeah, it's just a really great question, Frank, and I'll answer it twofold. First of all, in terms of the economy, just a brief remark on the economy. Remember, where OPEC is judging this from is the sense that we are in this kind of sort of economic mire or weakness right now. But you've got to remember that the IEA upgraded its demand forecast for the end of the year. There's still potential for a quick rebound second half, and how much that's believable given the sort of two-speed China, given that the industrial weakness versus the mobility strength is still being played out. So on that sense, there is still a bit of a question about waiting and seeing still in that regard, especially with the debt ceiling situation and how that will unravel. But in terms of Russia is a bit of a black box. I think the Kepler comment sums it up, but they are a bit of a black box. They've taken their numbers out of official domain. And the question really is actually how much, and it feeds into a bit of a question about OPEC generally, about supply versus production. How do you measure a cut? Do you measure at the wellhead, or do you measure it in terms of exports? Because it seems that actually production is being cut, but the supply is still flowing at the moment, and it's coming out of storage. It seems, for many analysts are looking at, and so there's that factor at the moment. How much this plays into the OPEC Plus meeting will be crucial, because remember that Russia and Saudi are aligned, and if the 500,000 barrels a day cuts from both parties won't happen if Russia is seen as reneging on its part of the agreement. And where does that leave Saudi Arabia? Because in terms of pricing power, in terms of what it can deliver, is it really going to deliver any more voluntary cuts without Russia on board? Probably not, because it could look like it's a little bit going solo. And the OPEC Plus agreement is fundamental to pricing power. So there is a massive complication, but at the same time, it seems like Russia and Saudi are still aligned in terms of what they want to deliver for in terms of market management.
Right, but how much longer can that carry on if it seems as though, Russia just isn't coming through with what it said it would do? Saudi Arabia, perhaps coming under pressure to cut more. How much longer are their interests aligned?
Well, they got burnt a couple of years ago when they had the falling out, and you see what happened to the oil market then when they couldn't agree with it, and they came back to the table. I still think that's fresh in the memories, and I think they'd be mindful not to blow up any deal. I think there's still that kidology. Remember, these are all competitors as well as allies in the global market, and when the pie gets smaller, it's things are getting a bit more fraught, and there's a lot more kidology. But you've got to think that they are going to stay the distance, at least in the near term. It's just in their interest too. So it could be a bit of a fudge in terms of numbers, because it allows it, given that, like I said before, Russia is a bit of a black box now. So there's ways of arguing what those cuts may be from Russia. Okay.
Tony Quinn, operating partner, ProStar Capital, CEO, Tank Bank International, normally in Singapore, but joining us today from Fujairah in the UAE, where he's been visiting his terminals. Tony, your thoughts, please. One of the things that OPEC will definitely be looking at, as Ram mentioned, is Chinese demand, and those signals seem to be pretty mixed, I have to say. The post-COVID boom hasn't really happened, or is it happening more slowly than expected? We're not sure. You're usually based in the crossroads of Asia in Singapore. What's it looking like from there?
So really, the Chinese demand, you're right, it's sort of blowing up and down a little bit, but in general, it's pretty stable. So it's not hugely volatile. I mean, what tends to happen is when we have a cheap oil price, of course, all the compulsory stock fills up. That's the first thing they always do, and they've always had a huge demand for that at all the terminals on the Chinese coast. And I think that's a sort of big one. Once they've done that, then it's really whatever the strategic and domestic demand is doing at the time. Obviously, we're out of COVID now, so all the cities are open. Everything's sort of back to normal. Here well, I'm not in Singapore today, but when I'm in Singapore, you see now, a lot of tourism opening up. The Chinese borders are open. The Singapore border is open to China, so we're getting a lot more tourism coming across. All those sort of activities tend to sort of grow generally, everything from aviation to domestic ground fuels. So I think that where we are at the moment is you're going to see the demand growing over the rest of the year now in China. It's picking up quite nicely. We're a joint venture with Sinopec here, so I actually have the Sinopec board guys next door in the room, and we were talking about this over dinner last night. And Sinopec see a huge growth in their business. I shouldn't really talk for them, but it's interesting that they see that. They certainly don't see any negativity in the markets going forward. So it's good to hear that from technically the world's largest oil company, right? By purchase power, definitely, with 1 million employees, 2 of which are here. So in a sense, I see that demand increasing. I see it getting stronger. And,
some question mark, Tony, sorry to interrupt, but there was some question mark over diesel in China. We know that gasoline is picking up. We know that certainly jet fuel is in big demand as they're flying again. But what about diesel to drive manufacturing, construction, etc.?
Well, diesel stroke fuel oil, I suppose we take them, is really, factory production and obviously trucking. And there's an awful lot of trucking that goes on in China. So as again, the domestic market is picking up, because don't forget, we're less than 6 months since opening. So, it's starting to pick up, it's growing. Diesel will come back, but also there's a lot of diesel manufacturing going on, of course. Because the crude that's going in, obviously China's the biggest crude buyer in the world. The crude that's being refined there is going into all products, not just gasolines and jet fuels, but also the diesel cuts in there first. So it will be going into the domestic market. So there might not be a demand for buying, but there will be a demand internally, which is produced through both the teapots and the state-run oil companies and refineries there. So I don't see that as an issue. And I think the stability, I was just going to quickly say, against the comments that you made in the report about the US debt, the one thing you don't ever see is you don't see the Chinese talking about, the whole market's going to crash because we can't agree on a number. That would never happen, right? So the stability in financial markets in China is much stronger than the US. So, that's why I would count the chickens on the Chinese market being pretty stable going forward. And literally hearing that firsthand last night was interesting to see how that's growing.
Okay, interesting first-hand comments. Just briefly, how are the Fujairah terminals? Are they full?
I have to say, the terminal I'm sitting in, which is Fujairah, that one. Sorry, I'm looking the wrong way around. The Fujairah oil terminal, which is one of the largest terminals here in Fujairah, we've had a situation where we had one tank empty for 2 weeks since we opened. That's the only time. Those 2 weeks is the only time we had an empty tank, and that was quickly rectified. So and we've been open now since 2015. So we've had a long stretch. The tanks are all full and all contracted. And of course, with storage, don't forget, it's not always about the tanks being full. It's about who actually commandeers the facilities. So the big traders, which we have here, and obviously the major oil companies, are a key factor in holding those facilities and using those facilities as they see fit. So, we've had a situation where volumes of Fujairah are now on the increase. They were actually pretty low at the beginning of the year, but that doesn't really affect the storage positions, because the storage positions is about your contracted volumes. And so the whole terminal can be contracted, whether or not it's got oil in it, or as I call it, glider fuel when the tank's empty. That's the differential. So, but the terminals are doing very well, and there's 11 terminals here. And they're all pretty successful. I've got to say, it's a good place. It's a good house on a good street, if you like, from a storage perspective. Anyway.
Okay, Ram, let's go back to you to talk about India, because the country really has emerged as a big player in the geopolitics of the energy industry since the invasion of Ukraine. 40% of its oil now coming from Russia. We heard on this show last week. Now, you can see why India wants cheap Russian oil, but as I understand it, Russian crude isn't the best for Indian refineries, and at some stage, you'll have to make a big bet to adapt refineries to take Russian oil with all the investment that needs, or go back to taking Gulf Mid-East oil. So what's your take on that? How permanent is the India-Russia oil alliance?
Yeah, that's a good one. That's a good question, Frank. Yeah, so let me spread up my answer in 2 parts. The 2 big private refiners in India, one is Reliance Industries, second is Nayara Energy. Now, both of them have got the configurations to handle different kinds of crude. In fact, the Reliance plant is one of the most complex across the world, and they've been one of the biggest importers of Russian crude. So obviously, like the private refiners have got everything set up to handle a big amount of Russian crude. Now, coming to the public sector refineries, like the big oil companies, even some of the recent refineries and some of the refineries been set up, let's say 15, 20 years back, they have also been able to handle the Russian crude. But obviously, you are right in saying there's a limit to it. There's a limit to which they can handle these kind of crude. So obviously the price difference has played a big role right now, and which has pushed up the Russian crude to around the Russian crude consumption in India to about 40%.
Yeah.
But at one stage there'll be a bit of a limit, and India would like to play it geopolitically also, where they would like to keep spread out the risk across all the different oil producing nations, because geopolitically India is getting much more closer to Middle East. So therefore, there's no way can India afford to sort of
Yes.
neglect the Middle East also. So therefore, at one stage, the geopolitics has already started kicking in, and given the refineries configuration, so that'll be a playoff. But obviously, right now, looking at the way the economy is working right now, the way all the refineries are configured right now, Russian crude is here to stay for quite some time, and probably a good part of India's import basket will be Russian crude for the time being. That's the way I can see the conflict of the merger of geopolitics as well as economics playing out right now.
Okay. Paul, the reason Russian crude is cheaper is mainly because of price caps and sanctions. What's your view on those? Have they worked? Have they been effective in reducing Russian revenues while maintaining overall volumes?
Yeah, well, I think it's the bigger question is, it's a question, has it worked? This really feeds into two things, like what was the intended aim and what do you mean to get the result from? Yes, it has reduced Russia, the revenues for Russia, it looks like, but at the same time, they were never aimed at reducing supply. They've reordered flow. They were never aimed at, because obviously consumers are too, it's too important, the energy, to stop the energy flowing. So it was always trying to hurt the Russian regime in terms of revenues, and which to some degree it has done. What's the ultimate aim? Whether it's, to try and hurt Putin and hurt the regime, it's probably negligible. If you look at the way sanctions have worked even in the past, Iran, Venezuela, it's a slow burn, but it's not really led to any effective regime change. If that is the political goal, it's not really change anything other than probably hurt the populations of those countries economically. So it is a sort of a complicated question in terms of what the real aims are and whether it's achieving those.
It has caused an issue for for Russian budgets. The deficit will be much bigger this year. But of course, whether that's a factor in how Putin looks at the war, whether he cares about that, if you're fighting a war, it seems to me you don't really count the pennies, do you?
No.
Tony, what do you think of this issue? As an oil person, I'm sure you don't like the idea of price caps, but do you think that they've been effective in what they were aiming to do, i.e. to keep oil flowing while reducing revenue to Russia?
Yeah, so I have to be careful what I say in case I get in trouble here, but I mean, the oil is still flowing. I'm sitting in amongst 11 terminals here, and probably 50% of them are full of Russian product. So, it's still moving. I was interested also in the fact that even Germany are buying via a non-sanctioned Russian pipeline. It was one of your comments that you sent earlier on. I think that's quite interesting, and that's increasing, right? So volumes are getting out. I don't think the Russian regime has been hurt at all by this. In fact, I think it's probably done a lot better, and particularly in its flows to China and India, as we mentioned earlier on. I mean, at the beginning of the Ukraine situation, suddenly India went up 25 times in terms of its buying of crude. It was amazing, and Ram knows more about that than I do. But I think that in general, I'm seeing more flows. I'm seeing a lot of traders taking Russian flows directly into here. We've seen product moving from here to all sorts of strange places that you would never expect to be exported to. So there are big movements, particularly out of this part of the Gulf, of Russian crude. It's all been diverted. We have a different customer base, whereas it used to be bunkering the Q80s. Now we're now unloading the Russians. So it's a different model. I mean, my question is, if you like, as a commercial director of a number of terminals, is, what happens when this stops? Because actually we have a different model we're using here now. Things like the bunkering market has changed considerably over the last year or so. What happens when it all goes away? Where's our new business going to come from? So it's quite interesting sort of looking at the future of where this goes, because this could end up like another Afghanistan. It'll all suddenly, myself and Paul had this discussion last week, actually. It'll end up as another Afghanistan, and it'll all fizzle out. The Russians will back off, and then we're back to square one again, and we don't quite know how we got to square one, and there's no real resolution. So I'm sort of, I don't think, I will sort of slightly disagree with Paul. I don't think it's really hurting the Russian regime at all.
Right. Okay. And the product that you mentioned that's being diverted elsewhere, I guess some of that at least must be Russian product that's ending up in Europe. Which is contrary to the aim of sanctions, at least.
Well, our friends from Kepler and Vortexa will tell you how many ships shift nationalities, how much product changes hands off water, on a ship-to-ship transfer that we don't see here at the terminals. Right. When offloading a product here, or any terminal in the world, you have to remember that once they blend that product, the certificate of origin changes. So you're suddenly dealing with a product that has a new origin. So if it's that here, it suddenly becomes UAE product, whatever it was before. So all of those things happen. So looking at the flows, they're always very confusing, because you don't really know where the product is coming from. The Kazakh product that's going to Germany, is it actually really Kazakh product? All those sort of questions come into play, because you don't know whether that was a shipped in, shipped out Kazakh product, or whether it actually came from a Kazakh refinery. All those things are at play here. So there's a lot of confusion. And that makes it very difficult, particularly for people like Paul and Ram to understand what these markets are doing. It's easy for me because I see the volumes coming through the pipeline and going out again. So I see the physical movement, but right. So I'm seeing it in a slightly different perspective. But yeah, it's a very difficult prediction, I think, at the moment.
Yeah, sure. Let's go back to OPEC Plus. Because Prince Abdulaziz bin Salman, Saudi energy minister, had some strong things to say at the Doha forum earlier in the week. He had another go at the IEA, quote, "It takes a special talent to be wrong so consistently," he said, close quote. This little feud is bubbling along nicely. But he also threatened to make the speculators ouch again, as he says. He means to make them pain, to make them hurt. They ouched in April after the surprise voluntary cuts then, and they might ouch again. Watch out, he said. So if we could call up the survey question, please. I want to talk for a little while about speculators and speculation. So the survey question is, OPEC's obsession with speculators and speculation is a distraction from its real job of trying to balance oil supply and demand and optimize oil prices. And it's a single choice. Just agree or disagree, please. But let's talk about that for a while, please, if we can. Because speculators and speculation has become a kind of bête noire for OPEC and the Saudis in particular. But I wonder how big a factor you see it in determining oil price levels or causing volatility. I sometimes think it's the kind of oil market equivalent of the theory that, George Soros really controls the global economy by a vast conspiratorial network. Bloomberg weighed in on this debate today with a couple of pieces saying that that OPEC in the long run could not win its fight with speculators because it really was a fight against the market. Tony, what do you think? You must rub shoulders with oil traders all the time. Are they really the bogeymen that OPEC likes to make them out to be?
Well, they're not. It's not all about the traders. The speculators don't have to be traders. We do have speculation, of course, amongst the banking and the investment companies as well. And they will weigh in if they see a position that they can actually put money on, particularly if we've got quite a volatile oil market, if it's really moving up and down fast. So, in the old days, you used to have the big American banks always used to have a speculation division, basically. I think they called it their trading arm, but they really didn't own very much oil. What they did was to buy in and out of the markets. And that is still happening today. There's still quite a lot of US activity in the oil markets and in this part of the world as well. That's really just weighing in on where the oil price is going to be tomorrow and weighing out again. And that will really change, your oil price perspective over the next coming weeks. So I actually think, as your question said, I actually agree with that. I think it is a distraction. There's no way you're going to get speculation out of the oil market because it's the oil market and that's what it does. It wouldn't be a market if we didn't have speculators. So, in a sense, I think it's a distraction. I think it's, don't look at us. We're just a poor little oil producer that happens to support one of the largest countries in the world. But, it's not something that really should figure in a decision by a major oil company. That's always going to be there. You have to believe that that's always going to be part of the market.
And indeed, the oil companies themselves have big trading arms, including Saudi Aramco.
Yes.
Which also make a lot of money out of trading on prices, and having a look at future forward prices. Paul, London is another big hub for oil trading. Do you think the short sellers really ouched in April, if only briefly, because the price went down pretty soon after? And will they ouch again in June if the signals coming through actually materialize of more cuts?
Well, I want to just step back a second and talk about a bit about what the intention of Saudi's policy is. And I think they're trying to draw a floor under prices. They wouldn't openly admit that. It's almost a case of, to paraphrase Bruce Lee, the art of targeting prices without targeting prices. And I think it's really a question of how Saudi see physical flows versus financial flows, and they're very much focused on the physical market, Saudi, and the way they see and where they see the price should be for them. I mean, yes, there's a physical consideration, but also where they see the market. And obviously speculators and the financial community see it slightly differently sometimes. They have different positions due to where they see the prices going for various reasons. The question really is the effectiveness of what we kind of see as a Saudi put. If you go back to what this is modeled on, which is the Greenspan put of the 90s, where the Federal Reserve Chairman tried to backstop the market in the currency market, and they're trying to do the similar. Saudis are trying to do the similar thing. They brought in a price band in 2000, 2005 OPEC, and they abandoned that when it failed. And while they wouldn't go back to a price band, this is kind of a looser version of that, with a kind of de facto floor they're trying to implement. The effectiveness is always questionable, because it arguably could lead to more volatility rather than less, and that is a debate that's being played out by many analysts at the moment.
Where is that floor, Paul, do you think?
Good question. It's a moving target. I think most people thought when Saudi came in at 80 it was about 80, but probably the market has its own floor. This is the problem, that the Saudis may see it as around 70, that what they're going to tolerate, but it relates to the question of how much Saudi can think they can get out of the market by cutting, what revenues they can get in return. And that's always a moot point. It's you never be quite sure what appetite they have to cut to bring those extra revenues. And you'd probably think that there's a tolerance up to about 70, but below that, it starts getting to the 60s again. If the Saudis think they can wrestle it back, this is also the question, is how much they feel they can wrestle the market back, depending what's driving it. If we're talking about the debt ceiling and questions around the banking crisis, how much can they wrestle that back? And that's a big question that only really Saudis could answer themselves.
Can we pull up the survey result, please, if possible? Right, yeah. Not really surprising there in a room full of oil people, but yes. So they should, they are obsessed with this, and it is a distraction. I'm inclined to believe that, I think. Interesting. Ram, let me go back to you on the same issue. Some closing thoughts, if you would, please. Prince Abdulaziz, he wouldn't like the card playing analogy, I know, because he said in Doha that he doesn't play poker, if you got that bit of his little speech. But will OPEC stick, OPEC Plus on June the 4th? Will it stick or twist, or whatever the poker equivalent is, call or bluff or something? What do you think? So will it more cuts or maintain status quo?
Well, I wish he starts playing poker, because as what Tony said, I work in the commodities market day in and day out, and there are a lot of different kind of players, banks, the hedge funds, financial institutions and all. So this kind of volatility is a part and parcel of the commodity markets. So people have to live with that. And the survey rightly showed that it's more of a distraction. Now, coming to a question on what's OPEC going to do, frankly, I'm still not able to put my money as to whether they'll go in for cuts right now. Because if they go in for a cut and the prices move up, again, it will lead to some sort of destruction in demand also. And they'll be swayed by what is going to happen geopolitically also. But from the signals which we get from OPEC is probably they are inclined towards making a cut. And if not so, they're trying to build up a base to make a cut, and by giving all kind of signals to short sellers and all. So that's the way. That's the kind of signals which I see from what the statements have been made. Obviously, they want the prices to be high, but they also want to balance the demand also and the volatility that happens in the market. So what's going to happen the next 1 week will sway what the decision they're going to take. But it looks to be that they want to give some firm signals to the market given the weak macroeconomic conditions. So that's the kind of positioning that's taking place right now.
Right. The other possibility that we discussed on the show yesterday was that they would formalize, institutionalize the April the 2nd round of cuts, and perhaps even extend those to some other smaller OPEC and OPEC Plus members, the ones that can, that are in a position to make cuts. So that's another possibility. But sure. I guess we're still 10 days away. A lot can happen in 10 days. 10 days is a long time in the oil business. And indeed in politics and geopolitics. So we'll have to wait and see. But look, thank you very much, the three of you, Ram Narayan, Tony Quinn, and Paul Hickin. It's been a very interesting discussion. Thank you very much. We'll come back to it sometime after June the 4th, the three of us, I hope, and we'll pick over the bones. Thank you very much indeed. Good to speak to you all.
Thanks, Frank.
Thank you.
Thank you.
Thank you, everyone.